Welcome to this explainer, where we're going to act as your personal guide to demystifying one of the absolute most important daily data dumps in the entire financial world. We're talking about the Federal Reserve's H.15 release. Now look, if you've ever stared at a massive government data table and felt your eyes just instantly glaze over, trust me, you are definitely not alone. But today, we're actually going to translate that raw data from May 2026 into the real-world cost of borrowing money. Okay, let's dive right into this and see how these numbers actually hit your wallet.
So let's start by defining our source material here. The H.15 is published every single business day right on the dot at 4:15 p.m. Eastern Time. You can kind of think of it as the daily report card for the U.S. economy. It essentially serves as the ultimate definitive benchmark for the cost of capital in the United States. And whether you're a massive commercial bank, a small business owner, or really just someone looking to buy a house, the rates published in this release are the invisible forces shaping your day-to-day financial reality. To make sense of all these varying percentages, we're going to look at the data through the lens of a ripple effect. First, we've got the federal funds baseline, then consumer and business borrowing. Next is the Treasury yield curve, and finally, factoring in inflation.
Part 1. The federal funds baseline. We begin our journey at the very center of the pond. For the week ending May 22, 2026, the effective federal funds rate held completely steady right at 3.62%. This is the pebble dropped into the water, right? It's the baseline rate that banks charge each other to lend money overnight just to meet the reserve requirements. Literally everything else we are going to look at today stems directly from this core number.
And this baseline isn't just some arbitrary number chosen in a vacuum. The fine print of our source material tells us this 3.62% is actually a volume-weighted median. It's based on real transaction-level data collected straight from depository institutions. So it is a highly accurate reflection of what it genuinely costs banks to borrow from one another on a daily basis.
Moving on to Part 2, consumer and business borrowing.
Let's look at exactly how that baseline rate translates to everyday businesses and consumers. If you're looking to take out a loan, the number you really need to watch on the H.15 release is the bank prime loan rate. For the week ending May 22, this rate sat at 6.75% across the board. Notice that jump? We went from banks borrowing at 3.62% all the way up to consumers and businesses borrowing at 6.75%. And honestly, this brilliantly illustrates the basic mechanics of banking. As our source notes, this 6.7% is the foundational rate that the majority of the top 25 insured U.S. commercial banks use as a starting point. It's the baseline to price your short-term borrowing costs. So if you've got a credit card, a home equity line of credit, or a small business loan, your interest rate is more than likely tied directly to this prime rate, plus whatever margin they add based on your credit score.
All right, Part 3, the Treasury yield curve. Moving further out into the broader economy, we look to how the U.S. government borrows money to fund its operations, which they do through Treasury securities. Now, to accurately compare totally different borrowing timelines, the Treasury uses a pretty brilliant mathematical method called constant maturity. The H.15 release explains that this allows them to interpolate or basically estimate exact yields for specific timeframes, like exactly 10 years or exactly 30 years, based on active over-the-counter market trading. What this means for us is we get a clean, standardized rate for fixed maturities, even if a bond with that exact lifespan isn't actively trading on that specific day.
When we check out the short-term constant maturities from May 22, we see this gentle upward slope. It goes from 3.72% for a one-month commitment, creeps up to 3.79% for 6 months, and hits 3.86% for a full year. This shows a very normal market expectation, right? Investors are demanding slightly more return for locking their money away for longer periods.
Now let's see how this builds when we look at long-term horizons. As we stretch that timeline way out to the long end of the curve, the cost of borrowing climbs much more noticeably. It hits 4.56% at the 10-year mark, 5.06% at the 20-year mark, and peaks at 5.07% for a 30-year commitment. This curve really represents the market's collective wisdom on the future risks of time, economic growth, and, perhaps most importantly, inflation.
Which brings us to Part 4, factoring in inflation. So here we are at the outer edge of our ripple effect. We have to talk about that invisible force that constantly erodes the value of money over time. And the H.15 release is actually incredibly helpful for this because it tracks a special category of bonds called TIPS, that's Treasury Inflation Protected Securities. Unlike standard bonds, the principal amount of TIPS is directly adjusted based on inflation. Because the principal's protected, the yield you get on a TIPS bond represents the true, real cost of borrowing, with all those inflation expectations stripped right out.
When we compare the standard nominal 10-year rate of 4.56% against the inflation-protected TIPS rate of just 2.16%, a fascinating story emerges. Investors buying the standard bond are demanding a significantly higher yield because, well, they're taking on the risk of inflation just eating away at their returns over the next decade. And we see this exact same stark contrast holding true all the way out at the 30-year mark. There is a 5.07% nominal rate versus a 2.77% inflation-indexed rate. That gap is remarkably consistent and, frankly, incredibly revealing.
So, the absolutely crucial takeaway here is this. The space between those two numbers is known as the break-even inflation rate. It represents exactly what the collective wisdom of the financial markets expects inflation to average over the coming decades. If we do the simple math for the 10-year mark, just subtracting the 2.16% real yield from the 4.56% nominal yield, we see the market is pricing in roughly 2.4% inflation per year for the next 10 years. It's truly one of the most powerful predictive metrics in all of economics, and it's just hiding right there in plain sight on the H.15 table. Let's zoom out for a second. When we look at the whole picture, the narrative of the H.15 release becomes crystal clear. You can really see how the initial drop of a 3.62% federal funds rate ripples outward. It creates the foundation for 6.75% consumer and business loans and stretches all the way out into the future to shape the 5.07% cost of long-term, 30-year government debt. Every single number is connected.
So now that you understand how to read the hidden inflation expectations embedded in these numbers, the real question is completely up to you. Will you be caught off guard by the changing tides, or will you use the H.15 data to confidently ride the financial currents of your next major investment? Keep these ripples in mind, and you're always going to understand exactly what the market is trying to tell you.